Hi.
The game is
Hi.
on here, Stacey.
Okay, great. Good afternoon, everyone. I'm Stacey Scott, and I'm the marketing coordinator here at Wickham Financial and Insurance Services, and I'm your host for today. Thank you so much for joining us for our June Lunch and Learn. We host our monthly Lunch and Learn typically on the last Wednesday of every month. This month, with the holiday approaching, we're getting a little bit ahead of that. But at any rate, we would love for you to spend your lunch break with us on those Wednesdays and give us the chance to share some valuable information to you. Today's session should be a really good one. Graham's going to give us some valuable information on inflation and its effects on the market. And then we're going to be joined by Patra Francis of My Ally Tax, LLC. And she's going to share some timely information on tax policies proposed by the Biden administration. Excuse me. As always, we're going to have a few minutes set aside at the end of the webinar for a Q&A session. So if you happen to think of any questions throughout the presentation, please just type those into the Q&A section of the chat box and we'll answer those for you. You'll see Graham's calendar pop up from time to time during the presentation as well. If you want to schedule some time with him, just click on that calendar when it pops up and select the time that works best for you. And other team members can be, their calendars can be accessed as well. Also, I want to remind you that if you've missed any of our weekly wrap-ups or our past Lunch and Learns, you can find those on our website. We've got a lot of great content on there and on social media, such as Facebook. So please take a moment and check those things out. And now that that's all out of the way, I'd like to turn things over to Graham.
Awesome. Thank you, Stacey. Yeah, thank you all for being on the call. You know, really kind of an interesting topic that I'm going to cover in my portion today is inflation compared to gross domestic product and the effects that it has or could have, at least based off the past, the effects on the markets. And that might be the U.S. stock market, like the S&P index. It could be the bond market. The effects to the markets is what we're applying to. So let's start out and just go over some basic definitions for our call today. So let's talk about inflation. So inflation is the measure of the rate of rising prices of goods and services in the economy. So it's the cost of the goods and services that we use on a daily basis and their advances upwards. So the added cost that is eventually passed on to us, right? And that's what we're calling inflation. We're going to call it the Consumer Price Index when we get into next couple slides. Then let's look at gross domestic product, or GDP. Gross domestic product, GDP, is the monetary value of all finished goods and services made within the country during a specific period. So how is the U.S. economy growing? Gross domestic product. Are we growing slowly or growing fast? Is the cost of goods increasing or decreasing? That is being taxed on the consumer or for companies, and that would be inflation. All right. So those definitions aside, let's go ahead and jump in. So if we look at some market statistics, we look at inflation. All right. So the current inflation rate really just popped up to about 5%. Its average is roughly around 3%, depending on any 10-year rolling period. But let's just say 3% for the call. Now, for perspective, in 2019, before we went into the pandemic, inflation was roughly around, let's say, just over 2%. So we've had well above 100% increase in inflation. But this is not to be unexpected. I mean, this is pent-up demand. This is supply constraints, all causing dramatic increase in inflation. Now, some will stick, some will pass through, meaning transitory. We'll just have to see. If we look at gross domestic product, how the U.S. economy is growing, currently it's about 6.4%. But look at these numbers. We usually fluctuate post-war era, 1950s on, somewhere between 2 and 4% in any rolling 10-year period. And if we look at 2019, before we went into the pandemic, you know, we were roughly around inflation rate, roughly around 2% We were actually slowing a pretty good bit, maybe around 2.4. So the argument was saying at that particular time, we could drift into a recession, but we went into a pandemic instead, induced recession, right? So that's the comparables. If we look at Bloomberg's survey of private sector economists, the consistent expectation for gross domestic product, that is the U.S. economy growing, is 6.6%. We're pretty much right there, right? If we're following those guidelines. If we look at 2022, they're expecting some of that to be transitory, flow through the economy, not repeat itself, meaning not stick to the inflation rate or gross domestic product, and will probably come back down, inflation as well as gross domestic product down in 2022. We'll just have to see how much sticks and what doesn't. But I think the interesting topic that I want to cover is, what is the effect? What is the effect when inflation is increasing and gross domestic product is increasing, and how does it affect the market? So let's go back to inflation. What are we feeling? What is the pain that we're feeling at consumers, either at the pump or with their everyday goods? You know, if we're taking a breakfast, and we talked about it in one of our weekly wrap-ups, look at milk up 4.5%, orange juice up 21%, bacon, like I said before, everyone loves bacon, it's up 13%, 2% for coffee, 16% increase in travel costs for airlines. Look at this one, 95% increase in rental car cost. So we are, as a consumer, as an economy, really seeing that inflation hit us, right? And that's fear. I mean, that's scary, right? So think about it this way. If we are paying more at the grocery store for those breakfast items we're talking about, or travel or whatnot, that's going to be less money or discretionary money we might have to invest for a new home, for a mortgage, whatever, or other goods we might buy. So that's how higher inflation can negatively affect. Think about it in the same way with companies. You know, if we're going through a period of higher inflation, see, that's going to negatively affect earnings for companies, right? So if they have to pay more for loans that they take out to run their business, or to buy the goods and services that they pass on to us, that we acquire, well, that's going to lower the profits and revenues. I think that makes sense, right? So that's how we're equating inflation to consumer and companies. Now let's think about gross domestic product. You know, during strong expansionary periods, which I would say gross domestic product at 6.4% is pretty expansionary, right? You know, inflation has had a muted effect on the stock and bond market. Now, I brought in an article, but I did not bring in all the charts and, you know, fancy visuals. But Jim Polson of the Luthold Group had a great little article. Happy to get it out to you. Just let us know. And it's called Searching for Inflation Firewall. So what could damper the negative effects of inflation on the stock market? Because generally, if costs are going up, that's affecting revenues. Stocks generally increase when revenues increase or earnings increase. They generally decrease when earnings or revenue decrease. But how is that firewall protecting the market, or could it protect the market? So let's think about that. During higher inflation, right, costs are going up. And at the same time, let's say that gross domestic product is really going up. We're earning more, so we have more money to offset the negative effects of those higher costs. And that can be for the consumer, and that can be for the company. You know, during the post-war era, when the pace of gross domestic product, quote from Jim and his team, was above average, the impact of inflation on the stock market was less dramatic. But let's think about the inverse. In a subpar expansion, all right, so we're not growing gross domestic product that much, which we are not in that period right now. But in a subpar expansion, economic activity is so modest, it magnifies the impact of inflation based on cost, right? So the stock market can be punished a bit during those periods, right? You're going to have, volatility that we've seen a bit. And I think you got to expect that volatility. The market's trying to figure out how much inflation, how much is transitory, how much the economy is going to grow to maybe offset that and create that firewall that Jim and his team are talking about over at the Luthold Group. You know, for stock investors, the sturdy economic growth has truly been a firewall. This is a quote from Jim against inflation. While paying more at for gas and retail purchases or labor and materials is never a satisfying experience. I don't think anyone was excited to pay a lot more. It is far less of a negative effect when we have strong growth in the economy. kind of wrapping it up on that sense, the economy is enjoying, and it's a quote from Jim and his team, some of its most robust economic growth in post-war history. Although the rapid rising inflation is always unnerving, currently the economy is prepared with a strong real growth firewall. So we continue to expect, with Jim and his team, as well as my team, we continue to expect to see strong economic growth going forward. Now, there'll be a period when that calms down a bit. Then we need to have the evaluation call. Okay, is inflation still elevated? Is it now going to be a negative effect on the markets? But all that being said, that does not mean that the markets are not going to go through some ebb and flow. So price appreciation, depreciation, rallies, as well as pullbacks or corrections. That's something we just have to understand. I'm not saying like it's just going to be a part of the environment that we're involved with. All right. So that kind of wraps up my portion. I want to go ahead and pass this on to Patra. I know she's got a lot of great information she wants to cover. So Patra, go ahead, take the call.
Yes, thank you, Graham, for the time. So the topic that we're going to talk about is about the Biden proposed tax policy compared to the current tax law. And we have a lot of information today. So just keep in mind that this is not an actual law yet. It's most likely the proposed policy must make it through the House of Representatives and the Senate before it's signed off by the president. And in addition, it is also rare to see retroactive changes. However, it's not impossible. Therefore, you should consider being prepared if there are retroactive tax law registrative changes in 2021. And so one of the first changes that we expect to see, which is the corporate tax rate. There is the current tax rate for the corporate tax rate is the flat rate of 21%, but with the Biden, it would increase by 7%, which is 28%. The proposed would be effective for the taxable year of December 31st, 2021. And I put a simple case study here for the C Corp with a net income of 3.5 million. They would pay additional of 245,000 in income if compared to current tax law. And there are some planning consideration. Consider you taking dividend of the retained earning before the end of the 2020. I know that right now it's a little too late, but however, since it's not become law yet, you can still do it. And hopefully it's not going to be retroactive. And another consideration is, to change the legal entity from C Corp to an S Corp to avoid double taxation at 28% and 39.6%. Another changes that we expect to see is on the capital gain tax rate from 20 to 39.6%. Currently, we have the three rates for capital gains, which is 0%, 15%, and 20%. With the Biden plan, would increase the capital gains for high income earner who making over than 1 million. With the 1 million threshold, capital gain would be taxed at the highest individual tax rate. So we do not have detail on the implementation of this tax increase. But however, if you make less than 1 million, it's not going to affect you anything. And this is just some illustration that we put together from the campaign. And also, there are a little case study for Sally. After working hard for 25 years, Sally feels sold her business for a net profit of 2.5 million. The gain from the sale will be taxed at the capital gains rate. Let's compare the result under the current law and the Biden plan. Sally would have to pay 294,000 additional more than the current law. And planning consideration is you can, consider gifting appreciate asset in the future year. And another thing that we expect to see the change is on the top individual tax rate from 37 to 39.6%. This increase, currently we have 10%, 12, and 22 until up to 37%. We don't expect to see any change for the people who make income lower than 400,000, and the proposed would be effective for the taxable year beginning after 2021. And so this is another case study, right, for James. Received W-2 income of 800,000, and James also have capital gains of 1.8 million. So as you can see that he's gonna have to pay more, like 140,000 more because of there are, because he make over than 400,000, and the capital gains rate for him is going to be higher too because he make over than 1 million. And some planning consideration is he can consider accelerating income in 2021 through converting traditional IRA to the Roth IRA, or exercising stock option and taking bonus earlier, or determine how long you can defer income and wait for possible tax cut later. This consideration may not occur for like 4 to 8 plus years or longer. So we just, hoping that maybe there will be a tax cut later, but yeah. And then the next thing is another changes that we can see, expect to see, is on the elimination of Social Security tax cap. Currently, what we have is if you make over than, if you make under 140. Currently, both employer and employee pay Social Security taxes at 6.2%. Each on wages up to 142,800. After 142,800, no additional Social Security tax is paid by employer or employee. With the Biden plan, we'll start taxing Social Security again for wages over than 400,000. As you can see here, this will leave a donut hole between 142,800 and 400,000. That would not be taxes. This new tax threshold has no upper limit, so all the wages above 400,000 will be taxed at 6.2% for employer and employee. The portion of the wages below 142,800 will continue to be taxed as they are currently. Some planning consideration: consider switching to an S Corp, to a Schedule C, and consider deferred compensation strategies. Consider adding additional retirement strategies to reduce taxable wages. And also another changes that, on the phase out of the Section 199A deduction, or you also call it QBI deduction. Currently, unincorporated businesses are eligible for 20% deduction based on the QBI income. The Biden plan proposed phasing the deduction out above 400,000. We do not have the detail about the phase out and have not made the assumption that the QBI deduction is completely phased out at 400,000. The QBI deduction already phased out for specified service, trades, and the business. This new limitation would most impact the business with the high W-2 wages and with the business that have significant unadjusted basis immediately after acquisition asset. Then we're gonna, for the case study, are we gonna share the slide to the people later, Graham, Stacy?
Yes, we can do that.
Yes,
We can make
so
those
we can
available.
come over and take a look at the information here. But I'm gonna skip on that. I know that we don't have a lot of time and we have other things to cover. So and the next thing is on the estate tax rate. What we expect to see is the estate tax rate currently we have at 40%, and it could change to 45%. And in 2020, the current estate and gift exclusion sit at 11.58 million for individuals and 23.16 million adjusted for couple. The Biden plan would roll this exclusion back to 2009 level. This would result in estate tax exclusion of 3.5 million per individual, which is like a big difference. It would also cap lifetime gift at 1 million. The Biden plan further calls for increase in the estate tax from 40 to 45, as I mentioned earlier. And this topic, many people, would be interested in because of the Biden plan proposed several changes to eliminate the current 10,000 state and local taxes, or we also call as SALT taxes. And this gonna, people who live in California or in New York, it would be beneficial for them because they can take more deduction. And second, it would cap the benefit of itemized deduction to 28% of the adjusted gross income for taxpayer who earning more than 400,000. And for the retirement, this is very interesting topic for me too. The Biden plan would eliminate the current deduction for 401k, IRA, and other retirement account. Instead of deduction, a refundable credit of 26% would be implemented. This will be a benefit for lower income taxpayer, but will result in a lower deduction for higher income taxpayer. And some planning consideration is, you can reducing taxable income. So your marginal tax rate is below 26% will maximize the retirement deduction. And you can also increase retirement contribution may help to reduce your marginal tax rate. And Graham probably know more on the retirement on that. Then for the tax credit, I'm going to go through it real fast. For the tax credit for the earned income tax, they expand the earned income tax credit to childless workers over age of 65 and child and dependent care credit. They increase from 3,000 to 8,000 and up to 16,000 to multiple dependents. The maximum reimbursement would be raised from 35 to 50%. On the child tax credit, raise the child tax credit from 2,000 to 3,000 per child. And if the child is younger than 6 years old, under 6 years old, they can get an additional of $600. This credit would be paid monthly instead of one lump sum. And also on the first-time home buyer credit, they're gonna re-establish the first-time home buyer credit to be advanceable, refundable credit of up to 15,000. And rental credit create a refundable tax credit for low-income renter that would cap rent and utility at 30% and of the monthly income. And the last one is the Made in America credit. They're planning to give the 10% advanceable tax credit for revitalizing existing closed facility, retooling certain facility, reshoring job to U.S. facility, and expanding current U.S. facility. And they're going to reduce the deduction for the people who outsource to a different country. Additional proposal. Do I still have time, Stacy?
We probably need to wrap things up. If you can just give us like maybe a 30-second to 45-second wrap up.
Okay, sure. I will do that. So another thing is that on the real estate, the 1031 exchange, there are some 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 planning that won't work under the Biden plan. Generally, the tax strategy that work under the current law will also work under the Biden plan. There have been some mention that certain real estate transactions such as Section 1031 like high exchange or investment in opportunity zone fund may be eliminated, but there are no specific yet. Therefore, if considering opportunity zone or like high exchange, it may be beneficial for you to do it sooner rather than wait for another year. So that's all I have. That's it.
Thank you so much. And like we mentioned, we'll make sure that these slides are up on our site so that people can really examine those a little bit closer. And I know your contact information will be on there too, right, Patra? So if they have any additional questions, they can reach out to you directly.
Yes, definitely. I also offer the free tax assessment one-on-one with me.
Oh, that's great. Okay. Well, guys, we do have a couple of questions that have come in from some of our viewers. The first one, I'll just start with Graham. Graham, do you think the markets are going to pull back up?
Could you repeat that again, Stacey?
Do you think the markets are going to pull back? Excuse me.
I mean, pull back or correct?
Pull back up.
Yeah, I think that's just a part of market, everyday movements, right? I think, we're up 50, 60+% in the S&P performance over the last couple of years. I think it's reasonable to expect some added volatility, some added angst, if you might, and we could see some markets pull back. Now, the real question is, they pull back how much, how long? We'll just have to wait and see. And I think that's going to be a little bit about what Patra's talking about. If you get an aggressive tax policy that's negative to the economy, or at least the consumer views it as well as high performance in the market, maybe some fear with higher interest rates, maybe gross domestic product isn't exactly offsetting inflation as much as we hoped to maybe create that firewall. I think the markets could have a larger correction of 20+%, but I think a garden variety corrections of 5, 10, possibly up to 20% should be expected at any time.
Okay, great. Okay. Patra, this one's for you. Under President Biden's proposed American Families Plan, as a high-income earner, what will my income tax rate be?
For the individual, right?
Yes.
So we expect to see about 39.6%.
Okay. Okay.
Right.
Well, I think that's
Stacey, can I ask a question real quick?
Absolutely.
Yeah. Hey, Patra, I'm hearing a lot about the stepped up cost basis or getting rid of the stepped up cost basis. What are you hearing on your side about that?
Yeah, that's a good question, Graham. I've heard about the step up basis too, that they were going to, I think, eliminate it. But right now, everything is just in the air right now. And I think it's still on the table but I think the last time that I saw on the budget plan that came out on May 28th, they have not said anything much about it, but I think it's still on the table.
Yeah. I mean, that's definitely one way that could negatively affect,
definitely
generational wealth.
Yes.
And if anyone wants more information on that, hit our calendars and I'll definitely add more clarity on the stepped up cost basis. Thank you, Patrick.
Yes.
Okay, guys, I guess that's going to do it for this month's session. Thank you to Patra and to Graham for sharing your expertise and for providing us with all of this information. And thank you to our viewers as well. We appreciate your time so much, and we hope you learned something valuable today. Remember to join us next month at noon. It'll be the last Wednesday of July for our next webinar. And until then, please catch us on Facebook for our weekly wrap-ups. And you can also check out our website to stay up to date on what's going on with us here. Have a great afternoon, everyone. Thanks so much.
Thank you.
Thank you.